How is the capital adequacy ratio calculated? Have you ever wondered how banks ensure they can handle financial challenges? One key measure they use is the capital adequacy ratio. This ratio helps assess how well a bank can absorb losses and protect its depositors. In a capitalist system, this measure plays a vital role in maintaining trust and stability in financial markets. Let's break down how this ratio is calculated. To find the capital adequacy ratio, banks use a simple formula. First, we look at the numerator, which is the sum of two types of capital, Tier 1 and Tier 2. Tier 1 capital includes the bank's core funds, such as common stock and retained earnings. These funds are readily available to absorb losses. On the other hand, Tier 2 capital consists of supplementary funds like subordinated debt and loan loss reserves. These provide additional protection if the bank faces financial difficulties. Next, we move to the denominator, which is the bank's risk-weighted assets. Not all assets are treated equally in this calculation. Each asset is assigned a risk weight based on how likely it is to default. For instance, loans to governments are considered very safe and may have a risk weight of 0. In contrast, loans to individuals or businesses are riskier and receive higher weights. Now, let's put it all together. The formula for the capital adequacy ratio is as follows. Capital adequacy ratio equals the sum of Tier 1 capital and Tier 2 capital divided by risk-weighted assets, multiplied by 100%. This calculation gives us a percentage. A higher percentage indicates that the bank is better able to absorb losses, which is reassuring for both depositors and investors. In the context of capitalism, a strong capital adequacy ratio signals a healthy, well-managed bank. It reassures market participants that the bank can withstand financial shocks. This reduces the risk of bank failures and protects the broader economy. Regulators set minimum standards for this ratio, but in a competitive market, banks often aim to exceed these minimums to attract more customers and investors. Practically, banks use this ratio to guide their lending and investment decisions. If a bank's ratio is too low, it may need to raise more capital or reduce risky assets. Conversely, if it is high, the bank may have more flexibility to expand its business or pay dividends to shareholders. Understanding the capital adequacy ratio helps investors, regulators, and the public assess the safety and soundness of banks. This assessment is essential for the smooth functioning of capital markets and the overall economy. So, the next time you hear about the capital adequacy ratio, you will know exactly how it is calculated and why it matters in the world of banking and finance.